Good afternoon, everyone. We're going to get started here. So welcome on this rainy afternoon, everyone that made it in person. And I know we have a big crowd online, so welcome to everyone that's joined us online. We're happy to have you. My name is Shannon Schaff. I'm the Executive Director of the CFA Society of Minnesota, and I've been here about a year. And today we're very happy to bring you practical applications of AI and machine learning in investment management. Next slide, please. First, I would like to say a special thank you to all of our annual sponsors. Our annual sponsors are really key in helping us to bring programming like this to members of the society. And I know some of you might be represented in the room today. So thank you for your support. And then our next slide is a very special thank you to our event partners, which are partners that are specific for this event. So Digital Hub, and you'll hear from Mirzad, who's the founder, in just a few minutes. And then the CFA Society of Cleveland also partnered with us for this event today. So there's just a little bit of housekeeping. I want to go to the Slido slide. We will be using Slido. So for those of you attending in person, we're using slido.com for audience Q&A and polling. There's no need to download anything. You can simply scan the QR code. There's a little piece of paper on your table, or you can navigate to slido.com and enter the code that you see here, the 4239150. That is also on that little quarter sheet of paper. For those of you online, you're already where you need to be to use the Q&A, and all Q&A will be visible in the same dashboard. So, in just a minute, I'm going to turn it over to Mirzad Mahdavi, and Mirzad has led multidisciplinary teams and deployed large-scale AI applications in companies across multiple sectors, including financial services, technology, and energy. He's currently the managing director of the Digital Hub, and recently he served as the executive director of the Financial Data Professional Institute. Prior to this role, he served on the buy side as chief data officer and chief digital officer for major global firms. He also served as the founder and CEO of several entrepreneurial companies, and he came all the way from Texas. He was brave enough to come north to Minnesota, so please welcome Mirzad.
Thank you. All right. Thank you. Thank you very much for being here. Appreciate it. And I'll get started with my first slide, which is basically a survey of you, the attendees here, and a lot that are online right now. So it's really an honor to be here. So I'm really glad that we could work this with Shannon and Megan and CFA Minnesota and Cleveland. So I really thank them for that. So, and also, if you can look at the attendee profile, it's a pretty nice distribution of people, analysts, RIA, management, and CIOs, and alike. So, so we curated the program today to appeal to this spectrum of folks. Okay, so just in case if you're wondering about Digital Hub, it's a community of professionals with experience and track record in quantitative finance, AI, machine learning, and data science. So what do? We build practical tool sets right at the code level, actually, and data science training, and we wrap those two together. So as you learn, you also use at the code level the templates that are specifically designed for use cases in the financial sector. And you will see a few of those today. Okay. You also may know us as the people that publish our newsletter. We have a kind of a popular newsletter called the Digital Hub Insights. And the publishers are myself and Lucas and Cordell over there. And it has several thousand financial professionals as subscribers. So right now you can subscribe for free. So please do so when you get a chance. And you'll get our newsletter, which has the latest research on AI and machine learning for the financial services. Okay, so what is our approach at Digital Hub? And this has come from really our experience in this market sector, and it involves application of AI, machine learning, and quantitative techniques to all the steps of investment management process. So hopefully today, you'll see some good examples right out of this workflow, okay? So, once we do that, then you can see how you can use this in the processes that you are following, okay? So with that in mind, and you'll get some of the copies of these things, so you can see it later as well. So with that in mind, we have curated basically 3 themes for you today. We're going to work on 3 themes. One is the portfolio construction using machine learning techniques, okay? And also managers' due diligence with hierarchical clustering. So right there, we use 2 machine learning techniques in 2 different use cases, and we will show you. We actually show you. We're not going to talk about things. We're going to show it. We're going to show the code. We're going to show how it goes, so that when you're done with this session, hopefully you have a good feel for what it takes to do this, okay? The third part is really an interesting, I think you're going to really like it. It's an innovative technique of using ChatGPT and large language models that all came up with Lucas sitting here. So Lucas spent a few hours and he did something really innovative and fantastic in producing earnings analysis and sentiment scoring. And he brought it to a point where you can leverage, like you have lots of interns working for you in earnings analysis, but only using the power of large language models. So there's really good payback in this kind of use cases. So with that, we have organized the agenda for today in 3 parts. Session 1 is on application of data science in investment management and the workflows related to that. And as I mentioned, Cordell is going to talk about that. Session 2 is using of large language models for the same type of workflow that we showed. And on the third part, we're going to have a wrap up with a panel. The 3 of us will sit down and we'll take on questions from you, and we'll ask questions ourselves. And as Shannon mentioned, we'll have a Slido so that we can have some interactive discussions with all of you. So with that said, let me introduce Cordell to get our first session started. Now, if you don't know Cordell, standing over there, is raised in Montreal, 20 years of experience in financial services, specializing in quantitative finance. He previously worked as a quantitative analyst and portfolio manager for leading Canadian institutions, overseeing $2 billion multi-asset retail investment program. He is currently not only working with me on the digital hub, is also co-founder and president of Trend Profits, which is a quantitative finance and AI solution firms that he's started. He received his bachelor's in biology, which is very, very much targeted towards financial sector. And, but he complements that with a CFA, Certified Financial Risk Manager, and Financial Data Professional Charter, which I gave it to him. So, so with that said, I think we are set up for our first session. I'll be your moderator today. So in and out, I'll come back and entertain questions and ask some questions. So with that, Cordell, are you ready? Sure. Thank you.
Okay, so my presentation here is entitled Portfolio Construction with Hierarchical Clustering. Don't worry, I'm going to explain all of these terms after, okay? I'll make sure that I'll get rid of a lot of the confusion and the technical jargon here. So first off, thank you. It's a pleasure to be down here from Montreal. And let me just go through a little bit about what I want to talk about, what the agenda is. I'm always going to start by setting the objective, what I want you to get out of this today, what I'm really hoping that you leave here with, like, the take-home messages. I will set the context because this is part of what Mirzad described is how we can apply AI and machine learning in the investment management process. Now, there's very many different ways you can do it. We can't obviously talk about every single possible target for an AI algorithm, but I will set the context so you get a very good understanding of why we're doing this, where it's coming from, and how it can be used. Now, we also had that survey that was sent out prior to the event today. So I'd like to thank everyone that did send it in. I think we had over 60 responses, which is great because 60 times 5 tickers each gives me 300 investments to work with. So I will present a little bit about the results coming from that survey, and I'll explain why we even wanted to collect this data to begin with. And so because this is all about the investment management workflow, specifically about investment due diligence, portfolio construction, achieving optimal levels of diversification, and how some of these methods will help us to get around some of the, let's call it the shortfalls of existing methods that we typically use in portfolio construction today, especially centered around quantitative due diligence and portfolio optimization. So because ultimately we need to understand the investments that we are using in our portfolios. That is the fundamental thing that we as portfolio managers, investment advisors need to do, is understand how things are going to behave. So a lot of what I'm going to show you is how you could better understand an investment's behavior or confirm an investment's behavior, and then how that could actually be used to feed an AI algorithm. In this case, it's called hierarchical clustering. Then I'll just summarize everything and go on to Q&A. So I hope that works for everyone. I hope that meets your expectations. That's my goal here today. So I'm going to start right away just with my objective. I'm keeping this a little bit broad and vague for the moment, but we'll get more into this as we go on. But ultimately, whenever I do these presentations, especially when I start presenting to students at some of the universities in Montreal, and even with companies, it's time to start thinking a little bit differently. And when you sit down every day at your job and think about what you need to do every day to accomplish what you do, how can we improve it by using AI or machine learning? So in this case, it's specifically about the portfolio construction or the asset allocation mechanisms that we currently have. So that's my goal. Now, we will show this just because, as Mirzad put it up here, this is a very top-level view of the investment management workflow. Granted, and even the version of this that I have at home in my graph paper that I graphed out, you could subdivide every single one of these buckets here into a plethora of other elements that have to go into, how do you create your expected returns? How do you construct your correlation matrices? Every single one of these things here is a target for a machine learning or an AI algorithm. So no matter what your role is within this workflow, there is a way that we can use AI to probably improve it. The questions pretty much are today, does it exist? And will it work? And are you willing to use it? So by the way, if there are any questions, please let me know as we go. I'd love to answer as I go. So today we're specifically going to be talking about the investment selection process. Now, how I'm going to set the stage with that, I'm going to start by showing this. So before I launched Trend Profits earlier this year in July, my previous role here was working for one of Canada's largest financial institutions as a consultant working with our clients, which were registered investment advisors. I would be helping them build out their model portfolios. So whether or not you're an RIA or an institutional multi-asset manager, you're running a fund of funds, you are typically going to have some kind of structure like this, right? You're trying to build out a model that is scalable across your business, that you can typically group your various client types, whether into a conservative profile, which is, let's call it the 75% fixed income that you're seeing in this column, all the way to your more aggressive, which could be 100% equity. So ultimately what you're building here as part of your portfolio construction process is a model. You have a model portfolio that you want to scale your business across. It's much more efficient there than to have every client in, let's say, 250 different models, everyone's different. It's not really a scalable business practice. So what you're seeing in column A, the first column here, are your broad asset classes that you want in your model. So we're not going to talk about how you've determined which asset classes you want. It could have been done by portfolio optimization, or it could be just your philosophical beliefs, what you believe a portfolio should own to have that diversification. So just as an example here, I just put in some fixed income asset classes, some alternatives, same thing on the equity side. But this is, again, it's a very top-down approach. Like I said, we're starting with the broad asset classes. So the analogy I love to use here, and again, yes, I'm Canadian. There is zero chance we're not going to get a hockey analogy here, that you are building a hockey team. Your first decision is how many players do you want on the ice at once, assuming you could have more than 5 or 6, counting the goalie. So how many players do you want on the ice? But then what positions do you want? Do you want 5 forwards, a couple of defense people? Do you want a goalie? So the idea is, what is your mix between attack and defense, aggressive and conservative sleeves that you want in your model? And then after that, okay, let's say, who are your players? Do you want 5 Alex Ovechkins? Do you want a couple of Sidney Crosbys? So PK Subans, it's who do you want as your players? And that's the investment due diligence part of this. But ultimately, you need to find the best players for every position. So how are you going to do that? So if we started with the top level, the broad asset class, well, then you move on to your offense versus defense. What sleeves do you want inside your model? Are you going to have a passive sleeve? Do you want a more conservative dividend, low volatility? Or do you want maybe a more aggressive growth, small cap? You might not have it in every one of your profiles. There's usually a logical progression with the weights that you will ultimately choose in your model. But the goal here is, how are you going to achieve optimal diversification and make sure that you have selected the best manager for each one of these sleeves? And that's really what we're going to talk about. That's really the context that we're working here. Because again, the manager that you are selecting here has to fit what you're expecting. If you're looking for someone who's a dividend low volatility manager, they better be a dividend low volatility manager. How are you going to confirm that? How are you going to know if they style drift over time? And that's really what we're going to look at. So the typical approaches that we've had for how are we going to select our investments. The first step has typically been some type of quantitative screen. You might have access to a consultant database, whether it's Morningstar Direct, eVestment. There's no shortage of consultant databases out there that you could scan through to find your potential investment managers. Right? And a lot of this would work for individual equities as well, but I think Lucas is going to discuss a lot more of the individual equity side here. I'm going to stick with more of the managed investment product side. So you might have a consultant database. You're going to look do some kind of peer group comparisons. Maybe you're looking at quartiles. Maybe you're going to look at ratio performance, whether it's Sharpe ratios, whatever your preferred measures are. You might have a scorecard to rank your potential investment managers. This is the typical practice that we see, especially on the institutional side. But a lot of this, again, is going to come down to some of the subjective measures that you prefer, that you use in your day-to-day analysis. But you're normally going to start with a quantitative screen. Who's going to make your short list? Once you hit that short list, you then try and dive more into the qualitative aspect here. You might do an RFP process, right? Especially if you're a consultant working with plan sponsors, with pension funds, you will most likely be doing a lot of RFPs. On the retail side, you're typically talking to your company representatives, trying to learn more about the manager, the team, how they make decisions, Who makes the decision? What is their buy-sell criteria? These are the typical things you're going to do in your qualitative aspect. But a lot of this, again, whether or not you have that internal skill set, a lot of places don't. They might outsource this to consultants, but there's always going to be this qualitative screen. I know very few people that are going to, especially with current regulations, especially in Canada with our know your product regulations and suitability, you cannot just put a mutual fund in there because a wholesaler took you out for lunch one day. Those days are long gone. You need to really demonstrate, well, we can always debate about the effectiveness of the legislation in terms of making sure you understand what your investment manager does and is it suitable for your clients, but you're going to be doing this one way or another. And then, of course, you might do some portfolio optimization. It's a little tricky to do this at the manager level, right? Because then you're going to have to start simulating returns and risk for an investment manager. No one can really simulate a 5-year or 10-year return for an investment fund. And then, of course, you always have to deal with constraints that you put into a portfolio optimizer and whether or not, those constraints are usually subjective. And optimization is a garbage in, garbage out process. Everyone's good? No questions? Great. Okay, so what is the problem? Why do we need to all of a sudden start doing AI to help us with this? Well, first off, right, when you do your quantitative screens, they're too often focused on point-in-time estimates. You're looking at a 1-year, 3-year, 5-year, 10-year ratio. It doesn't capture how things change over time. And when you just start basing something on a 3-year period, you're going to have sampling error. How is a correlation over a 3-year period representative of a 15-year period? So look, we have many ways that we can use to try and correct some of these things, but it's near impossible to eliminate all of these biases and errors that we have in these processes. And then at the same time, how can we ensure that we are maximizing diversification? If you want 2 US equity managers, whether they're small cap, large cap, low volatility, they're going to be highly correlated simply for the fact that they're US equity managers. But you could easily find 2 managers that are going about beating the S&P 500, but by doing different things. It's like trying to find 2 managers playing in the same sandbox, but using different toys to build the same sandcastle. Optimization, correlations, you'll never see that. You're going to be highly correlated just from the fact that you're in that same sandbox. And again, what's key here is the point-in-time estimates. You're never really going to get a true understanding for how things change over time. And that's exactly what I want to show you here. The model I'm about to show you is actually going to take into account how managers can change over time and are they consistent over time. So that's the first aspect that we want to deal with here. Okay, before I get into this, because what investments are we going to look at? And this is what the survey was for. I took all of the 300 tickers that were provided to me, and that's what I used to build this AI model. So this is all your choices. So everyone in here who responded, everyone online who responded, I'm using what you sent me. So that's what's going to be used to build the investment universe that we're going to start being able to compare investments. If I've got an investment universe of 100 or 200, there's going to be clusters in there. There's going to be groups of managers doing the same thing, and there's going to be groups of managers doing different things. How can we reliably know which ones are the same and which ones are different if correlations lie to us all the time? And that's exactly what we're going to show. So first, let's go through the survey results. So these were the top investments. I think there should be no surprise that we got a lot of passive in here, right? We got close to 70% of everything supplied to me were passive investments. And spiders, QQQ, these were by far, and I had multiple versions, right? So even seeing just 16 of the spiders here doesn't take into account any of the VTIs or any of the other, let's call it the mutual funds that are indexed to the S&P 500. There were a lot, okay? It shouldn't be surprising. This is the overall asset class distribution that was sent to me. So we're getting a lot of US large cap, very small amount of gold. So there were a couple of money market funds, 1 or 2 international fixed income, but the majority of what we were seeing here were equity, US large cap, which is great because we need an investment universe with enough managers in there so that we can start comparing them and build a reliable data set. So we are really going to be focused on a lot of the US equity here because when we start doing these AI algorithms and these factor models, you want to keep your universes as pure as possible because the more asset classes you include these models, it can start getting the data a little bit messy and you can get interactions that you really don't want in there, but I'm going to demonstrate all of this in a minute. And then of course I did a little bit of a distribution by state here to see active versus passive. And this is with the 60 responses. So well, Vermont got 100% active, but there's only one person. So whoever's there from Vermont, thank you very much. It's probably if you're in Burlington, you're 2 hours from me, so thank you. All right, so that's just a little bit about the survey results. I'll leave it up here for 2 seconds, just so you can see it. But I don't think I was surprised at all that I saw this much passive. Everyone good? All right, let's move on. All right, so I'm going to discuss now factor models. So a factor model, factors can mean a lot of different things to different people. But again, what we're trying to confirm here is behavior. What is a manager's style? Do they do what they say they are going to do? And is it consistent over time? It's okay to change over time, as long as the manager says we allocate tactically to different styles. We're going to move between small cap, large cap, growth, value. We will move between all of these. But if someone says, no, I'm a dividend manager, okay, then you should expect to consistently see dividend exposure over time. So if you run a factor model on a single point in time estimate, you're not getting the complete picture of the history or the evolution of that investment over time. And that's, again, I can't stress that that's really what we're after here, is to measure this consistency over time. And what we can do with this? Well, we're going to decompose the sources of return that we're getting from these investments. We're going to be able to decompose return and confirm investment strategy behavior. So I'm going to jump right into this model right now. So what I've done here, and I'm going to initialize the model, and I've already ran all this before coming here, otherwise we'd be waiting 10, 15 minutes for 300 investments to start running all through the AI. And I'll explain why I have the box here for remove S&P 500s after. I'll start with the all equity, and then I'll explain why we're going to separate the US equity after. So I needed a minimum of 5-year returns. So if you gave me an investment that had less than 5 years of a track record, I took it out. And I took out the fixed income here as well. I just want to get a much more reliable model. So I'm just going to initialize it. We're good to go. So I'll just start with a very simple case. We just take one fund and we want to see its factor exposures. So the first thing on the list here is the MSCI Emerging Markets ETF. Probably a good one to start. Okay, that's a good sign. But it's also the proxy I've used, so no kidding, it's 100% exposed to this one. And again, this is taking into account differences over time. Right, so let's go to this advisor shares. I don't know much about these. That's another good thing for me about this being Canadian. I don't know all of these. I'll make this a little bigger. I'll blow it up a little bit. So here, now you're actually seeing the factor exposures of this advisor, the advisor shares fund here, the focused equity fund over time. And as you can see, the dominant factors here, again, but we are including international factors here. I would probably prefer to take these out, because I'm dealing with a US equity fund. It could be polluting it a little bit. So whenever you do these factor models, no matter what system you're doing, you're typically going to have a set of factors that are more representative of the universe that you're looking at. But as you can see, okay, you got some mid-cap, some momentum. I bet you we can improve this a lot by just taking out the factors. So the one thing I forgot to say is I put 16 factors in here. All right, we're looking at mostly, here are the factors. You got the typical factors that you'd expect. I mean, if you're going back to that spreadsheet and your sleeves, these are typically the kind of behaviors you're looking for. This is what you're trying to fill your model up with, is investments that have some combination of this performance, of these risk exposures. But the question is, are all 16 of these important? Probably not. If you're dealing with a US equity universe, odds are, the fund could be cheating a little bit, go into some of the international equities. There's usually rules, especially with the Morningstar categories, what you can or cannot do. Most people do not want to get kicked out of their Morningstar category. So the question is, can I remove some of these factors that don't help us? And that's exactly what the first part of this AI model does, is when I go back to here, if I first just go to US equity only, and I'll reinitialize it, and I'll go back to the advisor shares here. So there we go. See, out of the 16, it's only saying that 12. Is it 12? 1, 2, 3. Or it's even less than that. I think it's 12. 12 factors are necessary. These are the only factors that were necessary to take all of the US equity funds that I was given, explain all of the variation within those funds, and then assign them to clusters. Like which funds are doing the same things and which funds are doing things differently. So this is just one fund right here. right? So you can see this is a heavily defensive fund. That's its largest exposure over here. But let's do it with multiple funds. So using this kind of model, I can take, you want to throw an ARC? Let's throw an ARC. I'm just doing this randomly. Let's take a dividend fund also. Let's go to Dividend Vanguard, and let's see what comes up if I do a growth fund. I'll do another dividend right there. Using this kind of graph, I can now compare different funds. So I think shouldn't be surprised here. We got a little bit of value in both the Hartford Fund and the Vanguard Dividend Growth. Right? We got some US dividend. Okay, so we got a large amount of dividend exposure in our two dividend funds. Not surprising. And then here we got more momentum in ARC and this, and we get some small caps. So I don't think anyone here is really surprised at what they're seeing based on some of these investments that you might, I'm assuming most people know ARC and know Vanguard dividend funds. But this just allows us to confirm. Remember, this is taking into account how they've done over time. This is not a point-in-time estimate. So the AI here is taking, I think it's the 80 US equity funds from the total list and trying to group them together based on these factors. So what you're seeing here is a visual way for you to confirm the behavior of the funds that you're looking at for your model. And the AI has filtered out the factors, but now we're going to take it one step further. I want to know, if I come back to my model over here, if I'm taking, let's say, a passive sleeve, how do I know I'm actually achieving the optimal level of diversification by adding a dividend fund or a low volatility, or by adding a small cap? Fine, you might have a philosophical belief. Hey, I believe that adding small cap adds diversification. There's nothing wrong with that. But if you want to add in a little bit more of a quantitative aspect and to actually understand how these managers can work well together, well, then we need a way to compare them. And that's what the next stage of the AI is going to do, and that's the clustering model. So what we do here is we actually take all of the factor exposures for all of our funds. So we'll use the all equity. I think there were about 100 and something all equity funds. We take all of those factor exposures and then compare every manager one against another to see how similar each of these managers are. Who's doing the same thing, who's doing things differently. Now, just think about the power of that for a second, right? Because we're dealing with 12 factors. I think we filtered it down to 12 factors. But we're doing over 10 years of history that were combined, or I think it was more than that. I did like 13, 14 years of time series history here to analyze how they change over time to see how similar these managers are in terms of how they manage money. Now, you can't do that in your head, right? At least I can't. When you're dealing with 80 funds, 100 funds across 12 dimensions, and you're measuring the distance between all of these factors, this is a perfect use case for AI, and specifically a hierarchical clustering algorithm. So when I say, what the hierarchical clustering does is it's grouping them by similarity. In this case, it's the similarities based on the factor exposures, based on their behaviors. It produces a tree-like structure where you can just keep getting larger and larger clusters. At the bottom of the tree, it's like every fund is its own cluster. And then as we go up the tree, we get larger clusters until things that are doing things more and more similarly are all grouped together. So our goal here is, hey, well, why don't we just pick things from different clusters, because now we know they're doing things in different ways. It's a different way of achieving diversification without having to rely on correlations, which we know are fraught with many errors. So don't worry about looking at each individual fund here, but I just wanted to give you an example of what this tree looks like, because what you're seeing here is once we take in all these factor exposures, we can pretty much take all of our equity investments here, the 100 and something equity funds, and start grouping them by how similar they are in terms of the way they manage money. And again, like I said, you can pick one. So the orange over here are pretty much all your S&P 500. And you can see they're really separated from all of the other investments provided to me, which you provided to me. The S&P 500 index stuff only merges with the others at the top level. So clearly, this is evidence for you wanting to keep a passive S&P 500 sleeve because it's doing something very differently than all the other active managers that you decided to include in your search or your investment universe. Whether it's a Morningstar category, doesn't matter. That's another reason why I clicked on that remove the S&P 500 from my initial grouping, is because this way, let's take it out. If we know they're doing something so differently, let's kick them out, and maybe we can get even better results based on the similarities of how all these funds do. So I'm going to come back to that in a second. But just to give you an example, I can zoom in here for a second. I'm not sure if you can, how well you can see that in the audience. I'm sure it's a little bit clearer online. But even here, you can see this is where all your S&P 500 are. And then you go all the way to the opposite end, and you're getting the dividend growth. You're getting all your dividends. And notice how they're all being grouped together. That's a very encouraging sign when you're building an AI model, is when you start seeing the results that you were hoping for. All right, so I'm going to get out of this. I'm going to go back to my model now because we're going to move it to another level. But I am going to take out the S&P 500 funds now. All right, so now they're out. So I'm going to take a fund at random here, one that was provided to me. So let's say you're using this Oakmark Institutional. Did I do just US equity? I did. Okay. So let's say someone's using Oakmark Institutional. Okay, great. This is a fund I love. This is a fund I want to use. So tell me, what should I use that will give me the optimal diversification? And that's what this is designed to do. That's what this model, this type of AI is designed to do, is to tell you who's going to be different from what you're using right now. So if I just click this button here, there you go. What this is telling you, if you're, oh yeah, please.
I was just going to ask, what's the unit on these numbers?
So the question from the audience here for those online is, what is the unit here? It's almost meaningless. It is scaled, but what this algorithm does is it calculates the Euclidean distance between every single one of the funds. So if you feel like leaving now that I said that, I don't blame you. Please go. So, but the idea here is it's measuring the Euclidean distance. There are other kind of things that I'm experimenting with. There's something called the Wasserstein distance I'm trying to experiment with. But the Euclideans work very, very well in this case. But the idea here is if you're using the Oakmark Institutional, don't use these 5 over here. Use one of these 5 on the right, and you'll get optimal diversification. Why? Because their factor exposures over time are different than the one you're using right now. That's the message here. Sorry, was there a question in the back? Yes?
So is your data set price of these funds?
My factor models are running off regression models, returns-based, but using AI to improve the entire regression. And the reason why I'm very confident that it works is take a look at something like this. Like if we take a look at the Vanguard dividend growth that we saw before, I mean, I don't think anyone's going to be surprised with these results that you're seeing here. You're going to get your greatest diversification from using, let's say, the Vanguard dividend appreciation. That's the one over here. That's the one I'm more familiar with a small cap fund. And at the same time, if we use, if I take a small cap fund, we would expect to see this with other small cap funds. And that's exactly what you're seeing. So that's the power of this kind of model. And all this took was using returns and AI models. This was all done using freely, public available material. The returns are public. I mean, I have a paid source for my returns with trend profits and everything, of course, but you can download most of these returns on Yahoo. And all of the Python libraries, everything that you're seeing here that I built here to power what I call a cluster fund is using open source libraries. There's a lot in here I don't disclose how I do it, but the idea here is it gives you a powerful way of constructing a portfolio. So if I come back to over here, right, if I was going to use something, that's why I had it in over here. If I was going to use SPY over here for my passive sleeve, I now know that using a VGI or something like that is going to give me great diversification. I just confirmed it with the factor exposures and how it's being measured over time. And again, that's a key aspect, is that my model is measuring this over time. It's not a point-in-time estimate. And I'm so confident that the model works is because when I go back to this, I'm seeing results that I would expect to see. But I can even take this a step further. Let's say you're an investment advisor and you're getting a new client. You have your model portfolio you know that you're not going to be able to implement your model 100% into a new client's portfolio. It could take time. You could have tax consequences. Someone could have received a fund as a gift from their grandfather for Christmas 40 years ago that they'll never sell. There's always going to be these little elements that are going to stop you from implementing your model 100% of the time. There's certain strategies you can do to help with that. You can have a side account where you keep all your unmanaged assets there, keep your model in a pure account so you can measure performance. But the idea is here, okay, well look, I'm using that advisor share fund, and you're coming in with the Vanguard fund. Let's call it, we'll go back to the dividend growth here. How similar are they? So taking this one step further, I can visually compare how similar two funds are based on the universe that you're using here. So in this case, they're actually quite close. It's actually coming in, the dark gray area here is the main body. Everything else is going to be more considered an outlier. So anything in the first 5% here, the first 5 percentile, the bottom 95, okay, those are really, really close funds. But as you can see, these two funds are going to behave in a similar way. So if you do have to replace one of your funds in your model, okay, this isn't so bad. I can keep this Vanguard fund as a close proxy to what I'm currently using for my low volatility defensive sleeve within US equity. So it's just another way that you can look at it. Any questions? Because I'm almost done with this. We're all good? Hope everyone's happy. I don't know, I see a lot of angry faces out there, not happy faces. So if I come back here, this just gives us another powerful way to build a portfolio without having to use an optimization and worry about correlations. And I love to say this. One of the key messages I love to say when I demonstrate things like this is that, yes, LLMs are amazing. The generative AI is fantastic. But there is so much else out there in AI right now that can be done on smaller scale projects that don't require a team of Lucas caliber programmers and brains to build massive these GPT systems. There are so many other targets within that investment management pathway that we showed you before that are fantastic, fantastic targets for you to try and improve upon. Sorry, is that a question there? Yes?
You have 300 funds in there?
I started with 300, but I had to filter it down to take out the fixed income and then to focus on funds that had at least 5-year history.
So what is, with that criteria, what is the number of funds you can potentially put in there?
So the question is, what is the number of funds that I could have in here? There's no limit. But you want to keep your universe somewhat homogeneous, right? You don't want it to be all over the place where you're going to start getting model error.
That's what I was getting to. Yeah. As you add more, the distances become smaller.
Yes. Oh, yeah. If I go back to that tree, you would see a lot more groupings at the bottom here. Absolutely. Absolutely. I mean, the first time I ran this with an entire Canadian equity universe. Yeah, don't laugh. There's still like a few hundred funds in there, right? I think, if I take out all the multiple share classes and things like that you're normally going to get in your Morningstar universe, if you do your search in Morningstar Direct, you filter that out. I think the first one I did had easily 400 funds in it. It just becomes impossible. That's one of the reasons why I built this application, is because I'm staring at this dendrogram, what we call the dendrogram here, and I was getting nothing out of it. It's like, yeah, this is great. It looks beautiful. How do I use this? And that was really the plan, is by building that application, everything you just saw that I built was so that I had a way to communicate with the data and find the investments that I was looking for. But what I was saying before, having worked with so many RIAs over the past 3 years in that job that I was doing, and having built hundreds upon hundreds of models for people, the biggest challenge is identifying behavior. And I would always ask my clients this question. As a portfolio manager, what is the greatest risk that you face? Is it the black swan, the tail events? There's not much you can do about that. Those things are going to happen. Granted, low probability, but this is why we have risk management techniques, is to mitigate the effects of these events. We know bad things are going to happen. That's part of being in the market. We try and mitigate it with risk management. So what's the greatest risk that you face? The greatest risk that you face is when you think you understand an investment and then the opposite happens. You sold that investment to a client as a safe investment and the thing blew up. That's what costs you clients, and worse, could be in a lawsuit. So understanding the behavior of your investments, it's just simply of paramount importance. And that's the power of some of these AI algorithms. And that's what I was dealing with all the time, dealing with a lot of financial advisors, very large degree or discrepancy between skill set. So many were more financial planners than portfolio managers. It's really what their value proposition is and what they do for clients. But ultimately, understanding behavior is absolutely the most important thing, especially with how know your product suitability is changing like crazy, especially in Canada. Like the legislation is changing very quickly. So that's why I built this thing, was to help me understand behavior and be able to find the investments, confirm the investments that my clients were looking for. Well, at the same time, well, this is what you're doing. Are you aware of all of the risks that you're taking, how overly concentrated you are in growth? That's the one thing that I can easily say, and I'm sure very many people out there are guilty of this as well. Having gone through 2014 straight through, let's call it even 2021, I think everybody was overloaded growth. I think everybody absolutely forgot or underappreciated the value of a dividend sleeve inside your portfolio. I think everyone forgot why dividends are there. Not everything has to be 20% a year. What's wrong with 8% a year with 10% volatility? What's wrong with that? It's got a stabilizing effect on your portfolio. And that's why I'd always say, it's a risk budgeting. Your hockey team is a risk budgeting approach. The question that you need to figure out is how much attack and how much defense you want. And this thing could help you determine which ones are your attackers and your defensemen. So I'm going to stop there. If I just come back here, the summary here is very quick, actually. Mirzad, you could come back and take it over in a second. But the idea here is, we just discussed, like I just said, the importance here is understanding behavior. How can you confirm that behavior? And how could you make sure you are analyzing it over time instead of a point estimate? And then we could feed this into a hierarchical clustering algorithm, which can completely help us build a portfolio without getting involved with optimization and correlations. I'm going to leave it there. So if there's any other questions, please let me know.
Yes, there are lots of questions.
Oh, God, okay.
So I was trying to get your attention to answer those questions.
Okay.
Okay. So I've got a question saying, do you believe this process reduces and or eliminates the typical pitfalls of traditional returns-based analysis?
That's a great question. The answer is yes and no. Absolutely, it improves upon the weaknesses of returns-based style analysis. Look, I think the ideal world here, if you have access to all the data, is combine this with a holding style. If you can get holdings data reliable over time, and then construct those factor models based on the holding style, and then combine it with the returns-based, yes, that's something I do plan on experimenting over time. But yes, I am very confident that the AI techniques that I used here to address the weaknesses of returns-based do a very good job of it. Is it perfect? Absolutely not. Absolutely not. The AI techniques do a great job of focusing on the factors that explain the variance within your data set. But if your data set is imbalanced, it's only going to be as good as your data. So that's why I like to keep it pure with the US equity. I have no problem combining US small caps, mid caps, large caps. But the last thing I want to do is combine emerging markets with US equity. That will pollute the model. That's one of the reasons why I filtered it out.
Okay. Second question. Do you believe this process reduces or eliminates, okay, I asked you that question? Yeah, this one. At its core, what is the issue with correlations and how does the AI model overcome the issues?
Sure. Correlations are always going to be problematic because of sampling error. You're going to be basing it on a fixed time period. Whether you're doing it over 3-year, 5-year, 10-year, it's still being based on a time period. Yes, there are methods to overcome it. You can take a 3-year, a 5-year, and a 10-year, do some form of moving average of that. That's what we did at Manulife Asset Management. When we were doing our portfolio construction, we used to do that. That was one of the methods we used to address the correlation problems. They've got robust correlation estimations. Honestly, you can go to ChatGPT and Google how do I fix my correlation matrix estimation errors, and you will get a number of highly complicated methods that are used to address the problems in a covariance matrix. None of them are perfect. If they were, we wouldn't still be talking about it. The other issue that with the correlations is that they're very poorly understood. Most people think that it's just how two investments move against each other. That's not what it is. The correlations measure how two investments compare against their means, not against the entire variability. Most people actually have no idea, and this is something I encounter in the RIA world all the time. Oh yes, correlations, yes, but nobody really understands what they're measuring. So 2 problems. They're used incorrectly and they're fraught with estimation errors. How does this overcome it? Simple, we don't use them.
Okay.
That's the simplest answer I can give. I can really go on for longer, but I'd just be saying the same thing over and over again to kill time.
Another question, how do you monitor the results?
I'm not sure I understand the question perfectly, but from what I do understand is, if I go back to those distance scores, look, a lot of this is very intuitive. Like what we saw, we're doing the small caps. If I started seeing a lot of funds that weren't small cap funds next to my small cap fund, I would think I know I was doing something wrong. So the fact that the results are showing what we expect, I think that's part of the scientific method. Again, my biology days are long gone, and I told you it hit varying degrees of success.
Okay, another question is, and we have only 5 minutes for your time. What does the plot show? Where does the plot show the time? When you indicate, it shows over time. So I guess people are a little confused about the time aspect.
Yeah, I'm not surprised. I went quickly over that on purpose. That's a lot of the IP that goes into this model. Figuring out how to do the time varying nature or evolution of an investment is a huge challenge. That took me a long time to figure out.
Okay.
I'm leaving the answer at that. So any other questions from the room? Anything? Yes, please.
So, yeah, you can, you have all your small caps together and that's good, but have you tested these portfolios against, market backdated?
I have. That was the next step of the presentation, but I couldn't do all of it in 45 minutes. But yes, and you know what? It's just like in any other thing. Most of the results are going to be good. Most of the results won't. It really depends on the quality of the managers that you're picking. So, just because you've selected a 5-star Morningstar manager that went through your whole screens and everything, it doesn't necessarily mean you're going to have the best portfolio going forward. And yeah, it's back tested, but it's a back test. Have you ever seen a back test that didn't look good? I stole that from my last boss. He used to say that all the time. Thank you. I'll just leave it up there. If you want my contact information, please, it's all there.
So the next session on the agenda is use cases of large language models in investment management, and specifically we're going to talk about the analysis of earnings reports and then providing scoring index for those earning reports using large language models. So Lucas is going to talk about that in the form of introducing Lucas to everyone. He is responsible for building, testing, and deploying quantitative equity models for Thrivent's systematic alpha team. He's also pursuing a master's in financial mathematics at University of Minnesota. They call it U of M, but the real U of M is University of Michigan, but I'm not going to. All right. So prior to this role, Lucas conducted quantitative fundamental research at Mayors as Power, and he began his career at Wells Fargo Bank, working with a team to develop full balance sheet solutions for high net worth individuals. He's also, the main thing, it's very interesting, he's a co-founder and currently the a professional director of the Royals Investments Fund, a student-managed investment fund at Bethel University. That's very nice. Okay, Lucas, please go ahead.
All right, sounds good. Well, what I'm going to do is I'm just going to jump in here. I'm going to talk about large language models today. And at first, when we were talking about doing this, I was like, "Ooh, I really don't want to do the buzzword thing." And then I kind of started working with these models and started reading a little bit more, and I started playing with it and seeing some of the outputs, and I'm like, these things kind of work. And so I worked on it a little bit. Honestly, this probably took me a weekend to do. I'm not that great a programmer, despite the accolades I got from Cordell. Ask anybody on my team at work. But if I was able to do it, I think anybody with just a little bit of programming knowledge could do this as well. So what we're going to do is we're going to set up a problem. The problem is going to be earnings season. There's a lot of information coming at you during that time, as pretty much everybody in this room is aware. And it would be really nice to have a lot more, hands and eyes on these calls. But in the industry of fee compression, it's hard to hire an army of interns. So that's the problem that we're going to talk about. I'm going to talk to you then about a theoretical workflow that you could apply to the situation. And then we're going to take that theoretical workflow and we're going to actually apply it to a summarization use case and then a sentiment analysis use case. And then I'm going to talk about a little best practices and implications. But before we get started, let me just be pretty clear about this. This presentation is just a practical exploration of these capabilities in the context of this earnings season. It is not a lecture on the mathematics. If you want that, that's Vincent Hall across campus over here, where Eric and I have spent plenty of time. We're not going to talk about mathematics. We're not going to talk about the algorithms that are underpinning this. If that's what you were hoping for and you're online, enjoy your afternoon because you're free. And this is also meant to be some more, it's a simple example. It's not entirely ready for a production system, but I think it's honestly pretty close. At first, I thought, wow, we really have to build a lot of architecture around this in order for this to work. And the more I use this, and after seeing some of the results, I am not entirely sure that's true. So here's the problem. That image was generated by a very simple prompt by me, which was like, I was just like, make a picture on information deluge. And then it's like, what you meant was this prompt at the bottom. And then it gave me that beautiful picture. So there you have it. But basically, there's a lot of information that hits us during earnings season. I used to do a little bit of fundamental research myself. And so staying on top of that is very challenging. Investors really should be focusing on the future, and a lot of what they discuss is on the past, and then it's a lot of kind of sell-side analysts that are going and clarifying really a few numbers, trying to get the same information that they used to be able to get, but not really. And they're really not going to answer the really tough questions because, well, they want to be invited back to the next earnings call, right? So the level of information there is probably less than it used to be. And so that's the problem. A lot of information, hard to digest, very little bit of it is actually useful. So what can you do? This is what you can do. This is the entire workflow, and yes, it is actually this simple. The most important piece here is the prompt. I think the internet was pretty quick to call these like prompt engineers. Like in my mind, if you had to put engineer afterward, it's probably not like a real engineering discipline. But the prompt is extremely important. We'll talk about how I used certain, pieces of language to coerce it to do something, to give me a certain output, to give me a range of acceptable responses. Of course, you also need data. I had a little bit of a database of earnings transcripts, which I pulled from a third party for $20. It was really cheap. I'm sure the company that you work for already has that. And this is kind of like database loosely defined. This was all like in a CSV, and I just iterated through it. It was very, very simple, but I chose 25 companies at kind of random. I kept resampling until I got a pretty good distribution across sectors. But I didn't look at the results. Like it's completely different. So I pulled 25 just because I didn't want to spend $1 million doing this. And then I took those 25 companies and I pulled the transcripts and make sure that they had 5 years of transcripts for 5 years. So that's 4 quarters, 5 years, 25 companies. So that's 500 transcripts that we're going to be able to look at today. And then finally, the other input here on the bottom is the hyperparameters, which is a fancy word for things you change in the model and you really don't know what it's going to do until you look at it. We're not going to really talk about it all that much, but just know that those dials are there to change for you in order to get a different type of output. So you take all of those, you shove it into some code, you throw it across the internet, and for me, I used GPT 3.5 Turbo with a 16K context window, and we'll talk about that a little bit. That it's cheaper than GPT-4, which is why I chose to use that one. It actually still works incredibly well. And I did it across an API, so I did it over the internet, and then it was delivered back to me. You can do this locally if you pull a model and have it on your computer, but I also kind of learned you don't really need to do that because it's really not expensive to use the API, and it's pretty fast. So finally, you get a response, and the response is going to be completely dictated by the prompt that you create. And so for our 2 use cases here, we have the transcript summarization, and then we have the sentiment estimation. So this is our entire workflow here and theoretical. And still here, just because the prompt's important, I just want to give you a heads up on what you're looking at, really. And you don't have to read the slide because we're not really going to cover it. But the 3 boxes on the left there are the most important, right? There are 3 roles. There is a system, there is a user, and an assistant. The system is the persona that the model adopts. OpenAI has that as a default as a helpful assistant. You can override that. We want it to be an intelligent stock research analyst. Okay? That's what it knows about itself, and you can also set a few other rules. Like when you get a summary, this summary will be delimited by triple quotes, so it knows what to summarize. The user role is if you've ever worked or if you've ever used these like little chat bots or anything, the user role is what you would type in. It's the voice of the person, it's the voice of the requester. And then the assistant is the response from the model. Okay? And just to get a little bit better feel of this, this is, if you care, this is OpenAI's API documentation, and they have a playground. The playground is meant purely for you to try your ideas out and see what kind of response that you're going to get from the prompt that you specify, and basically the API parameters that you send it. This makes it super easy to know what's going on and to really calibrate what your response is going to be without spinning up a bunch, or without trying it and spending a lot of money doing it, and then having to redo it once you realize that your prompt wasn't any good. So I pointed out those 3 roles, okay? And they're all here. So we see right here in kind of the middle left-ish, we have the system role, okay? We tell it that it's an intelligent stock research analyst, and it gives the opinions on the performance of public companies in the United States. It's particularly good at summarization, and you will be provided a transcript, and only use data from the transcript provided to summarize the content, right? We're giving it some rules. It knows who it is, okay? And then we have the user. The user is what I tell it. Honestly, it's a little gray between those 2, right? Because you can put some rules in the user, and you can give it a little bit more context in the system, but play with that as you will. I have not figured out the best recipe for either of these. So in the user, I just kind of let it know, hey, earnings transcripts kind of have these 2 parts. The management has these prepared remarks where they just kind of give you an endless onslaught whether you want it or not. And then you have the analyst Q&A where it's the sell side asking good and thoughtful questions, but nothing too hard to make the management team look bad. And then I inject a little bit of other information in there, and we'll talk about that. And then I'm like, okay, let's summarize these discussed items that impact sales, margins, and earnings. Here's the transcript, and then boom, I put all of Walmart's 2021 transcript in there. Well, most of it. It's a 16K context window, and so I'm going to just talk about that for a second. The context window, and 16K is referring to the number of tokens. Tokens are like, there's like 1,000 tokens per 750 words, I think. It's parts of words that get sent. It's just the way that these things prefer to receive the data. Wouldn't worry about it too much. It's not a big deal. It all gets handled for you. But if you have a transcript, which is very long, and it's probably going to be longer than 16,000 tokens, you have to split this up. So you have to think of an intelligent way to split up your transcripts while you're sending it over an API. All I did was did a little bit of division and then made sure it ended on a sentence, and then I sent the whole thing, right? Sometimes you can do a little overlap. Sometimes you can actually identify when, it's a Q&A versus a management team or something like that. Didn't worry about it. And so that's what I did. And so I sent as much as I could over the API. And here's just an example of a response that you're gonna, good Lord, this one's long. A good example of what the summary looks like. Okay, there we go. So it actually gives you a nice header. It's the Walmart Q4 2021 earnings summary. That is correct. They reported sales of 150 billion. That's not a bad quarter. Blah, 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 blah. Okay, sell-side analysts at the bottom there focused on Walmart's higher capital spend, wage investments, and impact of the dividend, of div. Idend, right? I had a maximum length hyperparameter specified when I wrote that, so whatever. But the point is that this is a much smaller than the wall of the Minnesota snowstorm of text that you got here, right? So that's kind of the point. This is what we're talking about. This is what we're looking at. So that's the workflow. You can kind of see how this API is going to work. And so let's just dive in and see what I was able to figure out. So earnings summarization, this is on the prompt, and this is one-shot learning. The astute observer will realize there's only two roles, And that's what one-shot learning is. There's just a system message, and then the user just asks a question, and the model has to generate something, okay? So I gave it the persona of the intelligent stock research analyst, told it about the structure of the earnings transcript, as we mentioned before, told it that it was delimited by triple quotes, and then here's the prompt that I use. So this is actually, if you're a Python user, you know that this could be an F string because I have these little thingies in here, little brackets. That's how you know it's code, right? You got brackets and parentheses. So what I did in those little brackets, those are variables. So every prompt that I sent, I gave it just a little bit more information, some custom information. And I wanted to do that on the quarter and the year and the company name. Why? Because these things the large language models are trained on a lot of data. They have billions of parameters. And the way that it's all organized is like in a vector. And if you give it just a little bit more information, it can tilt the vector into a slightly different area than it otherwise would be. So the bottom line for that is, if you give it the year, there's other articles it was trained on that were from 2018. That might be useful information. I don't know. Again, we're not talking about the theoretical underpinnings. But you know that there's probably going to be a temporal aspect to what the model was trained on. And so if you can give it that context, I think it's helpful. Same with the company name. There's no way this thing doesn't know what Walmart is. And so I think that those things can be helpful to you as you inject these pieces of data into the prompt. And so I underlined, and I mentioned before that I wanted it to discuss the items that impact sales, margins, and earnings. This would be an awesome opportunity if your company has done a good job of keeping track of what the catalysts are for a company that you're evaluating or that's in your portfolio. If you have that sitting somewhere, you can inject those catalysts in there. I don't care about the performance. Just let me know if they talk about, let me know if Google talks about their cloud offering, or if they talk about their AI, or if they talk about these things. Otherwise, I don't care. It doesn't matter. You can do that. And then that will be more customized to what exactly you want to get out of it. So after doing this 500 times with all of these transcripts, I ended up sending between 1,000 and 2,000 API requests because I had to cut these up into like smaller chunks, right? It only took 4 hours. So assuming that you got all 500 transcripts, which you don't during earnings season for the S&P 500, you could do it all overnight. Everything could get summarized and sent to your inbox overnight if you really wanted to. So these things are not slow, and I'll show you later, they're not expensive. But what I'm showing you here is just an easy statistic that I computed, which is summary leverage, which is the original text length divided by the length of the summary in number of words, not that weird tokens thing. And so you can see that leverage, on average, you look at the bell curve, that's about 20. So you get 20 times leverage. So you're reading 5% of the words to get probably 90% of the information out of these earnings transcripts. So you get about 20 times leverage on average. The tails were just kind of weird, shorter transcripts that end up being like really short summaries. On the right, it's the same data, but I'm just giving it to you by word count on the left side to see that there is a diminishing marginal increase in the leverage as you add more word count. Or sorry, I have that exactly backwards, but you get what I'm saying. The thing is that part of that, though, I mean, just understand that there's a general trend there because by the nature of division, it's going to be kind of curved like that. But that's what you're looking at. There's kind of a weird outlier way out there, but on average, it's about 20, and really, 10 to 30 times leverage is what you're going to expect for most of this. So that was the summarization. I showed you an example of that when we were playing around in that playground. That's what you can expect. If you like that, then basically all you would do is you would save that transcript off, and then you can have another process sort of email that to the rest of your team. Use case number 2 here, sentiment extraction. So, I mean, what's kind of cool about this is you can take 30,000 words and reduce it to one number. And that's really what we're doing. So this is a perfect example for few-shot learning, right? We had one-shot learning before. It was system, user, and then we needed the response. Now what we're going to do is we're going to have like a fake conversation with ourselves. So it's basically the same system. I let it know that I'm just giving it summaries of transcripts because I want to reduce the cost for myself because I'm selfish. And then, but otherwise, everything's pretty much exactly the same. But this like user assistant dialogue is new. And this is actually kind of the idea of calibration, which is actually what Mirzad told me it was after I had created it. So I'm just stealing his word, really. But you can see the first one, it's the role of user. And then you see all this gibberish after this. What this is saying, what calibration in it is an initialization of the calibration. It's just a variable, and all it has is text. And the text just says, we want a number between 1 and 20. 1 is bad, 20 is euphoric, okay? We're defining the range. And then we have this other variable that is poor sentiment. Poor sentiment is an example that I crafted. Actually, I took like Signature Bank or Silicon Valley Bank's last quarterly call. Like, you want to see if this thing had a floor, right? And then what I did was I kind of took all the bank stuff out of it, right? I didn't want there to be any sort of correlation between poor performance or poor sentiment in banks. So I kind of normalized that a little bit, massaged it. But they were laying off people, they cut the dividend, they removed the guidance, all of this stuff, right? This is the stuff that it's important to know. And so I injected that one in there, and then I have the assistant pretending to return 2. And then I validate that answer. All right, that's a good response. Got another one for you to analyze. Give it the same, I want the 1 to 20 range, and I add positive sentiment. I'm pretty sure it was like NVIDIA's, when they absolutely, crushed sales earlier this year. And I had it return to 19. And again, validated that response and let it know that there's another one coming. And then I'd say, thank you, because my mom taught me well. And, ready when you are. And so I have this sort of like fake dialogue that kind of calibrates what we're expecting at each end. And then I purposely don't use 1 and 20 here because I want to give it some freedom on the tails to actually like put stuff that's worse than what I thought was bad, right? So there's a little bit of method to that madness. But you'll notice that I have it returning a single number. And so That's really important because otherwise it's really hard to pull the numbers out of the text that it gives you back. So that's a little piece of information that would be helpful to you if you're setting this up for yourself. So what we know about, earnings transcripts, if I have which I will on the next slide, a graph between, I think, 1 and 20, and it's a histogram, so the distribution, where do we think the average is going to be, right? Like, and I'm not asking like the exact number. Where from 1 to 20 do you think is this distribution, or how's this gonna look? Is it gonna be normal? Is it gonna be concentrated? Does anyone have any guess? Student T with a lot of kurtosis, like really tall or kind of normal?
I'm thinking kind of tall.
Kind of tall? Yeah, I know. You took the same classes. We were in the same stats class, so I know that he knew that. Kind of tall, that's good. Any others? Student T, do you think it mean around 10? Mean around 10, okay. Any others? Any other takers? All right, we're all gonna go with Eric? All right, that's dangerous. It's completely shifted over to the right because every management team loves their own company, right? Like, no one's gonna be like, oh God, that was a tough quarter, guys, sorry, This is exactly what I expected. And there were a couple bad ones, obviously, but in general, and there's a couple of euphoric ones, clear out at 20, so you have that. So what I did in order to like kind of normalize this was like, okay, maybe a management team is just like always, at 11 about their company. So I subtracted their mean over this time period, which does have look-ahead bias, so don't use this as an alpha signal. Just subtracting the mean, just kind of get, okay, if this was kind of above their mean, is this a good year? Is this below their mean? Is this a good week? Sorry, not year. I did this on 1 week forward active return. And what you get is that chart, that ugly looking chart on the right. But then I started kind of like squinting a little bit and I was like, well, I can maybe kind of see a line. And so then so I just took out the middle, right? Just to make it easier to see. And actually there is a little bit of tilt there. Okay, and 1 week is kind of when this settles out, right? Most of that active return is going to be in 1 day, and most of it is going to be at a time that you guys can't invest, right? It's going to be outside of market hours. So it's there to a certain extent, and so what I did is I just counted the dots. I counted the dots in the top right up there, and I counted the dots in the bottom left over here. So if it was less than 2 and a negative return, and if it was positive 2 and a positive return, 65% of those points were classified. And now I'm not saying 65% is, by the way, huge hit rate in finance. So I'm not saying let's go ahead and do that because again, there is look ahead bias, but I will say that, this is doing what I think it's doing. It is taking sentiment and it's understanding my request and it's giving something that is feasible. So this isn't like a super endorsement to go out and start using this for sentiment analysis for this, but this should be more so just an example to get you a little bit more comfortable that I think these things are, these models are capable of doing a few things well if you have a prompt that's designed better than probably what I did. And here's another example of that on the right. So instead of grouping by company, I just grouped by year. And I just took the average. So the average sentiment of all of the companies on the year. And I apologize for the x-axis. I did not know how to change that into normal looking years. But in 2018, 2019, about the same. Ho-hum years. We probably can't even remember what those felt like. And then 2020 drops off a cliff, right? And then 2021, total euphoria, right? And then in 2022, worse than 2018, 2019, but better than 2020. That is exactly the pattern that I would expect from those 5 years in the market. So to a certain extent, I think, one, these are doing what we think they're doing, and two, this example might honestly be a little bit of an indictment on the usefulness of earnings calls, but whatever. So a couple best practices, and then I'll kind of speed through these so that we can talk to the audience, open it up, and have a dialogue and answer some questions. But a couple things that I learned is that it's really easy to do these two things. It's to keep it simple and keep it cheap. I was listening to I can't remember what sell side firm put it on, but they had people really, really smart, high titled people from Microsoft who obviously knew what they were doing. They said 90% of the use cases that they and their customers have tackled can be done with the exact same method that we used right here. A little bit of that is probably a plug to use their API so they can kind of get that. But it's, you know, there's a lot of focus that gets to these vector embeddings. So we got to have these like really fancy titled things. And then you also want, you want to pull a, you know, model off the shelf and train it yourself. And, you know, Bloomberg GPT, has anybody used that? No, it's still not out there, right? You probably don't need those things. It's probably overkill. And I think you have a lot of good tools at hand right now, and they're extremely cheap. So those are my actual costs that I did this when I ran it. And that first one is, yes, those are dollars over there, and there is a decimal. So it was $35 to do 500 earnings transcripts, and then it was $2 each. I actually showed you the results from the first day. I showed you the results for the first day, and then I'm like, oh, I bet I can make this better, and then I made it worse, so I didn't show those. But so it was $2 each. Pay $2 to be wrong, right? It's like buying a lottery ticket. But the total is, you know, less than $40 for a person. That's affordable. For an enterprise, yeah, that's not a big deal at all. You can give these things more compute, like depending on what your use case is. Like if it's sentiment, you don't want that. If it's like a transcript, or if you want to gain some sort of analysis on a transcript, you can ask it to explain its reasoning, and it will use actually more compute from the model, and that does cost you a little bit more, but you have a higher opportunity to get a better answer or get more insight out of something by simply asking it to explain its reasoning or label some steps. The other thing, which I think is just like Pandora's box that will just open up a lot of things, is that you can have it call a function. And if you have any programming language, you know the responsibility that comes with that, right? But the thing is like, so you can structure the prompt and say, and tell it you have these functions that it's available to it, and it kind of knows what it does. So for example, you're at you have an AI that sits on top of your email. I'm not saying that's a good idea or endorsing that, but okay, it's reading every email that you get. You have one that comes from a client, and the client says, how much cash do I have? I want to buy a car. Well, if it's reading that, it will realize that it has access to a function that is get cash for client. And because it came from the client's actual address, email address, it will know what client it is, because you have that kindly stored in a database. And you can go out, you can grab the data, and then I wouldn't have it like reply to the client and say, you know, you have this much, but I would just have it reply to you and say, this client has 30 grand in cash, and they asked for it, you know, overnight while you were sleeping, right? Because it has an ability to call a function. And we can get into those details, and I kind of do here, so if you want to bore yourself with the slides later, you can read through that. But I think that's pretty cool. I think that opens up to a lot of potential possibilities, and hopefully someone more creative than me can come up with better examples. And then finally, for our industry, I think if you're a quantitative team like mine, you've been kind of evaluating NLP data sets for like sentiment and other things for a while, and they're pretty expensive. And I think their barriers to entry just got absolutely decimated with these, because you have like a base model for really cheap now. So if you are currently using one, I would try to rebuild it in this. It might take a person, a couple days to do that, and then you can see if the performance is there or if it's not. If the performance is better in the NLP, then you can feel better about it. If the performance is better with something that you're able to take off the shelf through an API, I think you have a couple questions to ask, or at least, and one of those, could be for a discount or for some sort of change in the terms. And then finally, a lot of this is exciting. It's really easy to get your mind kind of going way past what is possible. And at times, I caught myself doing that. And that's because we are like so in the middle of this hype cycle and the promises are really actually outweighing the reality. But any sort of problem that has this linguistic like inputs, anything that's language based, you know, and it has well-defined outputs, I think you can tackle to a certain extent with these types of technologies. But anything where the rules of the game are going to change, that's really difficult. Or if it's something that relies on pictures or like playing chess or something, it sucks at chess. And then if you change the rules of chess, it's going to be worse, right? Like it's not that type of model. If you have language inputs and want language outputs, this is the cutting edge technology. And finally, that last point is actually pretty important. And part of it is just kind of the language that we use to describe these models. It isn't actually reasoning. What this whole thing is a conditional probability statement, which is a really fancy mathematical term to say it's a big average. So at the end of the day, that's really all this is, so use that wisely. LLMs are easy to use. They're infinitely customizable because the prompt. Simple, I think, is better for now. You can probably use 90% of your use cases in the exact same way that I did. I have all the code on GitHub. If you want it, reach out. And then the sentiment analysis could be useful to some. You know, I think summarization is awesome because it has all the context in one sort of, in one single, I guess, package. If we use that, you know, package term loosely, I know that some people, like some tech people out there are like, oh, don't use package that way, but we're going to use it that way. And then we are also in the earliest innings of this technology. So I would get involved at a shallow level, if at all, but I would not be betting the farm on this thing. So anyways, there we go. That was generated by two. So.
Great.
Cool.
So any question for,
Should probably let that.
any questions for Lucas?
Have you implemented anything like this at your shop? And, because you're a Thrivent, correct?
Thrivent, yep.
Yeah. So how did that go?
I actually started working on this independently before I think we had any formal investment around it. The discussions are pretty early. I think we have a pretty good pipeline of use cases and ideas. I think very little rubber has hit the road on top of that, but obviously they at least have this, you know, I mean, be nice and give it to them for free, but yeah, I would say pretty much this. There might be some things that other parts of Thrivent are doing, but our team hasn't done much. Yeah. Good question. So,
Yeah, so I didn't ask you this before. I thought about this one during the presentation here. If you were to start giving this thing more context, more direction in terms of, let's say you're analyzing bank earnings calls specifically, right? Knowing that a lot of hidden information could be found in, let's say, the footnotes of the financial statements. If you start biasing it, saying, hey, I want you to spend more time looking at the footnotes, maybe not telling you specifically what to look for. At what point would you be introducing too much bias into this, or potentially getting hallucinations, which we know are a potential issue from the LLMs? I'm not sure if this is even something that you can answer. It was just something I was thinking about while I was watching that again.
yeah, it's a good question. For those of you online, if you didn't hear that, it was basically about, you know, what about the footnotes? And if you have it kind of really specifically trained to, you know, the example was banks, you know, are you introducing any biases? Yeah, it is a good question. It really depends on the type of response that you want and that you're prompting it to get, I think. So if you, and I'm really addressing the hallucination part of this, I don't know the bias. I think it's inherently biased, just based off of the data that it was trained on, right? And I'm talking about it as in maybe some sort of model that you aren't using that's super general, right? So if you use Bloomberg GPT or something like that, right, it's going to be very biased to that data set. But in terms of hallucinations, if you're asking it for something about those footnotes, you are very safe from hallucinations, so long as that your prompt isn't asking it to like write a dissertation, because eventually it kind of like runs out of stuff to say or starts repeating stuff, starts getting weird. But, or if you turn the temperature up on the hyperparameter, that's another way. But if it's something about the footnote, I think you're safe. If the entire context is there, you're okay. As soon as you start like asking it to like analyze or give, or, you know, kind of like have an opinion on something, then all bets are off. Yeah.
Questions from the audience? Yeah, go ahead.
Do you have any inklings of other things that you could use this for? Boardroom meetings or something?
Yeah, that's just, I've seen a couple products out there already in some integrations and stuff. So I use a note-taking app called Notion, and so they're starting to push stuff like that. If you have something that's recorded, OpenAI also has another program called Whisper that can translate voice into text. So if you string that together with the LLM, you get like instant summaries of stuff. So for like a board meeting like that, or class, you know, if you're going back in a master's degree or something like that, you can just have your friend sit there with the mic and not go to class. No, I'm just kidding. Yeah, I mean, lots of stuff like that's coming out. You know, I'd keep an eye on the products, and that's, you know, if someone made a product about it, there's probably enough there to make it somewhat feasible.
Yeah.
There's going to be a lot of failures, but I think they all kind of fail in the same direction, right, towards something better. Anything online over there?
A couple things come to mind as I think back to your presentation and look at AI. One is, do you look at the letter A as being artificial or like assisted intelligence? And the second one
That's
is,
a good question.
I also hear you saying that this thing is out there,
Yeah.
but the power of it and the value is dependent on the linguistic abilities of the human asking it questions.
Yeah.
So it still has a big limit on the front end of the human to then interface with what sounds like is assisted intelligence. Am I hearing you correctly, or?
Yeah, I think that's a really good way to put it. I think, you know, assisted intelligence versus artificial intelligence. I think actually probably the part of that word that's, I think, you know, most arguably debated is the intelligence piece. But I would say yes, in the context that I showed you today. There is something called LangChain that's used a lot in these applications, which is basically AI, large language models, rephrasing prompts and giving them to itself or each other to kind of get to a certain outcome. Obviously, you can see that once, it's kind of like the game of telephone, right? As soon as someone messes that up, then you're just like, whatever you get at the end is just like totally screwed up. But if you, not that anybody here probably uses Bing, but if you, they have that chat tab now, and this is actually pretty cool. So you can ask the chat a question, and then you can already start seeing your question being asked in a different way. And that is like a better way to ask that question. So in a way, they are all, we're assisting it. We have the original question, but you can see that it, even at the point of asking its question, it almost thinks that it knows better, right? And in that case, it does, right? Like this thing is going to query something. This is a huge thing that it's going to go search for. So that's where the vector embeddings come into place. They want to find the stuff that's the most similar, and they actually combine it with their regular search tools. And then they come up with a list of things that you want to know, and then it kind of puts it together. But the fact that it is already altering your prompt, you can take that and very easily abstract that to a world where prompts are just getting generated by these things. And maybe we start with the original question, but you know, maybe 100 prompts later, we actually get an answer, and it's a really good answer. So I think we have a big part right now in being the assistant to that, or being the part that is assisting it. And then I think over time, that's just gonna be less and less because we don't need it because it's better at finding information than a human would be able to ask for it. So just pretend I said that in a less depressing way.
So there are several questions. So one of the questions on top is, what is Lucas's contact information?
We talking about like phone number or no? Just kidding.
I have no idea how to do with that one, but
Yeah,
I think
Megan,
Megan will respond and connect everybody to everybody, okay?
yeah, we'll get you connected.
So
Sorry about that.
I think there is another question regarding, other than studying computer science, how would you suggest we get smart working with AI?
Mhm.
And anything more meaningful than just playing with the various tools?
I don't
Any
see any
thoughts?
problem with that for starting off. Like, the problem is that that's a really difficult question to answer because we're all comfortable with a different level of abstraction of technology. Some people need to know all the way down to the binary how a computer works in order to do programming, right? Or something like that. Me, I just need to be able to like type a few things in, you know, hit the go button and just like pray that there's no errors, right? And then I'm good with that. I'm like, oh, it worked, but it must be fine, right? And then move on. So first I would determine what type you are. Do you need to know everything before you can keep going, or find your level of abstraction and then learn past that? That's what I would do. I went a little bit more nuclear route by doing a financial mathematics master's degree because I wanted to know the math and I wanted to be a better programmer, but that's because that's the level to which I'm comfortable. Beyond that, like if you're really just starting out, like playing with that playground is absolutely where I would go. And then if you don't know programming language, the best way to learn is to have a project and just keep Googling until it works. That is it. That is it. You will be motivated to get it done. You'll know when you're done, and you'll have something presentable once you're done with that. So that's the path forward for me. That's the path forward for a lot of people. And truly, you'll see the code on GitHub. It is not that much. You'll be able to understand it with a
Very
little
good.
practice.
Excellent. So I think we are at a point where we can have a panel and really make it interactive with the audience, virtual and in person. So we're going to get that screen up. We want to start with a set of polling questions just to gauge where the audience is, and then go to a questioning and answering. I have a few questions myself I'd like to ask, and then we take it from there, okay? So, so let's see, this is the first question. And the way to do it is, I hope everybody knows how to do it by now. But, you know, if you get one of these, okay, then you can scan it, go to slido.com and answer the first question that is coming up. So where are we in the deployment of AI in financial services? So 1 is early development, 5 is advanced. So, and the results are going to show up in real time, okay? So I give you guys a little bit, a minute, right? Is that good enough, Megan? Like a minute to see the final results, and then we move on to the next question.
Maybe like
Okay.
30 seconds or something. Looks like it's working.
The
Yeah.
number in the corner is the respondents, just so you know.
What corner? There's 4 of those.
See 40,
Oh,
got
up there.
a lot of responses.
Okay, 48, you know.
All right, don't succumb to groupthink here.
So keep going. We want to see so that we can get some indications of the audience and where things are, because we are all interested in the same kind of questions. These questions that I've selected are basically thinking what we all want to know. Okay, so it's not changing that much, but you know, the number count is going up. It's very nice. Thank you for participating. So I think we are reaching the plateau here on the number of respondents. It's a good number. So I think take this down as one result that majority of you think that we are basically at the earliest stages of this thing, which is a very interesting point by itself, okay? So we move on from this question to the next question. Okay, let's get it started on this one. What is the most important benefit of AI in your business, in your opinion? What's the most important benefit of AI? Okay, all right, we are starting.
Oh, you're going to vote?
I'm gonna vote. This is the USA, baby.
All right, keep it coming.
Well, this goes, Mirzad, I'm kind of curious because like risk management can mean a lot of different things, right? There's so many different areas within
Yeah.
risk management, right? Even market, liquidity, operational, credit.
Right.
So I'm always kind of curious, you know, when people say risk management, what they really mean. So that's something that
I try
that
to
could be another
keep
question.
it at a kind of like a high level, just anything related to risk management, regulatory compliance stuff is separate. I separated that out. But okay, we're getting up there like the last time. Good participation here.
I find it interesting that regulatory and compliance is scoring so low.
I put that last.
But some of it is interesting. It's getting interesting because, well, portfolio optimization seemed like a high-level one, so
For like
Cordell
Cordell's-
must have
for
done a good
Cordell's-
job
Well,
on
great.
that one.
You know, but again, when we're talking about the portfolio optimization aspect, right? If we're looking, you know, portfolio optimization or portfolio construction, right? Because I
Yes.
would separate it out a little bit because there's a lot more to portfolio construction than just portfolio optimization. Yes, you can apply machine learning to the actual portfolio optimization process,
Optimization.
whether it's a better way to construct your correlation matrix or to find a way to estimate the returns for your asset class. You know, there's also hierarchical clustering that was used by Marco Prado de Lopez. Is it Marco Lopez de Prado or Marco Prado? The guy's like the genius. He worked for AQR. And a lot of the methods he applied towards portfolio optimization were used for risk parity.
Lopez de Prado.
It is Lopez Prado. Thank you. I always mess it up. I'm very embarrassed by that. The idea here is he was using it for more risk parity. And there are Python packages. The one I used is called Riskfolio. This one can actually do this kind of optimization with machine learning in it. Otherwise, I mean, if you really start breaking down the portfolio optimization process, you will find targets that you can improve with machine learning. The question then is, I'm not sure what the benefit will be in terms of economic value. Because if you're going to start doing portfolio optimization and you're projecting out 5-10 years, I mean, you could have the best ML models in the world, and I don't know how accurate 5-10-year projections are going to be. I mean, most people that throw their estimates for an optimization, how often have we checked if our 10-year estimates were actually correct? No. I would say very rarely, especially when dealing with international equities and other asset classes.
Only if used for political reasons.
Yeah, good. Yeah, that could be too.
So great. I think we've got the same amount of respondents. I think it's very, very instructive. Risk management is on top. Portfolio optimization and customer service and marketing is another one. I thought it was going to receive a good bit of voting, and it has. So, and I have seen this kind of a use case in the financial services a lot.
Me too.
using,
I would add, especially in Canada, I would say, considering that Canada is dominated by our banks, that is probably the largest area of investment from all the banks is in more their customer service, chatbots, things like that. And I think if anyone saw the article a few weeks ago from, I think it was on CNBC, Morgan Stanley rolled out an LLM for their wealth management business for advisors to pretty much query, say, give me all the research on this or find this for that, and they'll have an LLM ready for them to give their advisors that kind of information. So I think that those are pretty much the main use cases that I have seen have been more towards the customer service and marketing, but I am seeing a couple banks in Canada that are really starting to invest more in resources for their wealth managers, for the RIAs, to have greater tools with which to deal with their clients, not necessarily to aid in the investment, the investment selection, but much more in dealing with clients.
Interact with clients and segment the market, things like that. I've seen the same thing, so that comes out to be consistent with what we have seen around the industry. Okay, thank you very much. Next question. Okay. Do you see yourself using AI in the next 2 years? All right. Lots of a quick response. The pace is increasing.
I think the natural question is why maybe? What would hold you back? What are your concerns? Is it a skill set? Is it an ethical reason? I think those are some of the questions that I'm curious about. Why
I think
Yeah,
it might be the
we're gonna
company
talk about
allocation
that.
of resources.
Could be that too.
Yeah, we're going to talk about that during our panel Q&A. So remember that question. We can talk about that. Very interesting. He's getting up there. There are very few no's, but there's lots. Yes and maybe is a lot. Yeah.
I love seeing that.
All right, let it rip. I think that's
Yep.
all of them.
Move on.
All right. All right. Next question. This is an important one. I would be interested in knowing this one. Do you see technical background like Python programming or any technical, financial technical functions as a barrier to using AI? That came quickly, very quickly. Excellent.
There's got to be a winner.
We have
There's
lots
only
of
52.
respondents, and we have a real tie.
The votes counted in Florida?
Oh, yes, and maybe.
Okay, so what I can say is this. I asked the same question a couple of years ago from a similar crowd, okay? And the number of yes that were concerned with Python programming or technical were a lot higher. So what it says is that as a community, we have internalized the technical difficulties, and it's no longer as much of a barrier as it used to be even 2 years ago. So that's a very good piece of information. Okay, thank you for that. So with that in mind, I'd like to sit down with the friends, and I have a few questions, and I hope that you will have a few questions. And I have my computer here. Actually, this is Shannon's computer, and I can see your Q&A from online. A question came right up. So let me ask the question that just came right up, and then I'll ask my questions too. So my questions are more related to nuclear physics, I think. You guys ready for that?
Absolutely.
Okay.
Let it rip.
No, I haven't taken any science class since high school, so I'm going to be useless.
So the question says, have you seen any successful AI use case in picking stocks in the industry?
Yes, I have.
Go ahead.
Yes, I have.
All
I have
right.
seen some companies that have some pretty impressive products out there. How consistent they are, I think that's yet to be seen because it is still rather new. I have used some services in the past that I've had mixed results with. I found them inconsistent. In the
Yes.
end, a lot of them wound up being momentum plays. So the second
Yes.
momentum dried up, the services didn't do as well. I have seen a couple of other companies, one based out of Toronto, that is doing, I think, a fantastic job. I've actually seen some RIAs starting to use them in terms of their, let's call it their idea generation process. But I think the short answer is really, I've seen them, but the rate of adoption is incredibly low. I still hear so many people out there say, I'm not letting a computer pick stocks for me. But I think that's the wrong way to look at it. I think it's more to be used in your idea generation process, and then nothing's going to stop you from doing your own due diligence and making sure that the investments are suitable for your clients while at the same time do contain the characteristics that you're looking for in an investment.
Yeah, I would say that from my experience and from what I have seen, picking stocks and stocks behavior is a very difficult problem to solve. I think maybe when we get to quantum computing capabilities, we can add a lot more variables. But I have not seen any successful one at this point.
I think it depends a little bit on what you define as AI. I think that's a really gray term. And is there a line between AI and machine learning? Is there even a line between those two in statistics? I mean, Renaissance Technologies, it's just the best asset manager in the history of the world, has been doing machine learning for a long time. They just didn't call it that when they started.
Yes.
So the Medallion Fund is that. It's also the most successful. They also have a monopoly on some of the data sets that make it, make their edge very easy to harvest, and then they trade in a certain way to make sure that other people, that they cover their own tracks.
Yeah.
So, yeah, I mean, and then, again, it depends. And then AI, maybe there is one out there, and we probably won't know. So I guess I'd take the Bigfoot approach on that one, right? It's kind of hard to prove that it doesn't exist.
Right.
The other thing I would add actually is that I think it's very dependent also the kind of data that you're trying to use with which to predict the stocks. All too often I see, trying to predict the markets, return the next day or something like that, or too often just using technical indicators where, technical analysis is, I don't know what the exact success rate is. I am not a technical analyst, but it's got mixed results. If you're trying to work more with sentiment, then I think there are more use cases out there right now for trying to pick stocks using sentiment, that kind of things. X, I was going to say Twitter, using X, tweets and stuff like that to measure sentiment, stuff like that. That's been around for a number of years already.
Yeah.
That stuff's a little bit more out there. But when you start dealing with prices and you're dealing with low signal, high noise, then I think you're going to run into more problems with the models.
Okay. So I think Lucas has brought up a few questions from his talk. So one caller says, LLM is the best for text and languages, not so good with numbers. Okay. Do you see any other use cases in investment management with numbers?
Yeah, that's a good question. It's a good point. To my understanding, the LLMs are large language models, right? They're not large number models. So I think generally that's correct. However, lots of companies have either, with the chatbots added plugins, or, other software solutions have added things around the periphery to help with that. So like Wolfram Alpha teamed up with OpenAI to create a plugin for ChatGPT. So it recognizes that it's a math question that you're asking, and it farms that out to Wolfram Alpha, which is like the ChatGPT of math, basically. Gets the answer and then uses that in its response back to you. So yeah, I agree. In isolation, it's not very good, but I think what you'll see is potentially maybe like this sort of AI large language model that sits on top of a process that farms things out to certain things. Kind of, and that's why I brought up the call a function methodology in my presentation. That's effectively what it's doing. And to have something to be able to somewhat intelligently allocate the components of a question to its most useful, to its best use, I think is the real kind of promise there. But yeah, it's not good at math. Like don't try to do that. Like for example, I gave it returns of like 2 indexes and said, give me a correlation matrix, and it gives you a correlation matrix, and it's wrong. Like it knows what it looks like, and it knows, and it was kind of creepy because it was the NASDAQ and the S&P 500, high correlation. It knew that it was supposed to be high, like the numbers were 0.9, 0.8. But then I checked it, and it like wasn't wrong. So it knows what to look for. It doesn't compute
Yeah.
math.
But if the question was actually not necessarily based on LLMs itself, because, can numbers be used? Can we use numerical models to improve the investment management workflow? I'd like to hope yes, and I was hoping I demonstrated that. Maybe
Yeah.
not, but in my opinion, there's very many ways that numerical models can improve multiple aspects of the investment management workflow. And that was the point of that little diagram that we had up there, was showing a lot of those elements of portfolio management are targets for numerical
Oh, for sure.
That's true.
numerical ML models.
That's
Question
true.
was
I
probably
think
on the-
I think this was a really interesting question because I think the person was trying to understand how is LLM working with numbers, basically, which has been a source of controversy and things like that. However, GPT 4.0 and GPT 4.5 and 5 have, as you know, 1.7 trillion parameters. And so, and also it's not one model, it's 8 different models. So it is getting better, as Lucas mentioned, in separating the kind of question you're asking, if it's numerical or text, and putting it, dispatching it to the different set of models. And as a result, I feel it's going to get much better in terms of numbers, GPT-4 and onward. Okay? And by the way, I never thought we were going to talk about 1.7 trillion parameters, but that's what GPT-4 is rumored to be. Okay? So there is another interesting question, and please, the audience here, if you have questions, bring it up. As people use LLM sentiment analysis, do you think it could be a source of volatility in the markets based on how everyone feeds information to both? Okay? I think it's an interesting question because are we creating the volatility with this? You know, you showed sentiment analysis to be very efficient, in an efficient way. So are we efficiently introducing volatility to the market?
I think there's an argument to be made on both sides.
Yeah.
Like,
Yeah.
Good answer.
the quicker you can get to the right answer, the less volatility that you'll have. But yeah, at the same time, the speed at which you're able to compute information increases, volatility should increase.
Yeah.
So I don't have a good answer. I'm sorry, that's probably not super satisfying for you, but I could see a case either way and would be perfectly persuadable if you guys have opinions. on
It's
that.
just, I would compare this to algorithmic trading,
Right, well, yeah, but
you know?
We
Yes
already
and
do
no.
that.
Yes and no, because algorithmic trading, a lot of it's going to be based off the same indicators. If you get a lot of these high frequency traders, we know that a lot of them are looking for momentum. So
Yeah.
a lot of them are looking at the same sources of alpha to drive the algorithms. But when we're dealing with these LLMs, we have no idea if the LLM models are all going to say or do the same thing. If these LLM models all produce differing results, then it could nullify the added volatility if they're all taking different actions based on the results. If everybody creates the same LLM model, well, yeah, you're going to get the same positive feedback loop you'd get stuck with high frequency traders. That could
It
cause
depends
flash
on the
crashes.
temperature,
Yeah.
the temperature that
right.
Lucas was talking about. But you're right, I agree with you. Okay, I have a quick question, and please, from the audience and everybody else, if you have a comment, put it in. But my question for the panel is this. In the financial sector, I have seen a lot of pilots. People play a lot, and you saw that in the polls. You know, people are not worried about these technical barriers anymore. They jump in. But what I have seen a lot is that we do a lot of pilots, but we don't know how to scale deployments, how to get things to production. That is what I see as a major issue in the financial sector. I've seen other sectors doing the same kind of things, but what I wanted to know from the two of you or the audience is, what do you think? What does it take? Why don't we go from pilot to massive scale
Sure.
I
deployments?
can take a stab at that. So,
Go for it.
in general, the framework that I have, if you're looking to do this, is so there's like two kind of vectors that you can go along, and actually they're pretty parallel to each other. So, like the simplicity of the model and the riskiness of the problem you're trying to attack. If you start with the least risky, you'll end up using the probably more simple versions of the model. As you increase the risk, either to your company or, to some sort of response, then you're going to need a lot more infrastructure built out around that. So I think very naturally what comes out of that is a roadmap to get into that deployment is have some wins early on simple stuff that can definitely be used like a summarization type thing, and then kind of copy paste that to the next one and build around it for whatever that next use case is. And because this problem is going to be generally the same underlying until you get to a breaking point where you're searching so much information that you have that you need those vector embeddings, and then you can add that complexity. And then, maybe for security purposes, you really have to have this on-prem, right? The cloud is actually very secure. Microsoft assures us, right? Wink, wink. But
Yeah.
but if you really need something, then you need to pull that in, and that's a lot more architecture that you need. So if you start simple, get a few wins early, and then kind of show the business value of it, I think that's a really easy on-ramp to start complicating some things and tackling some of the more kind of like big and cool and really value generating.
Very good point.
Well, I would think actually there's a lot of problems that occur before you can even get to that point. And this is something that we learned, I think it was in a couple of issues, probably in the summer, one of our summer issues at Digital Hub, where I interviewed one of my friends she runs the digital innovation division consulting for Ernst & Young up in Canada. And some of the things we learned coming out of this, right? When you're undertaking a machine learning, from a business point of view, you're running a business. You're going to evaluate the business case for what you are trying to do. What is the economic value to the AI ML project that you're trying to implement? So you're going to analyze this from the business point of view. Resources, how do you make this work? How do you deploy it? The biggest problem that we've found that a lot of firms have for deployment, or why these things never happen, is too many companies are still working in silos. So if you do not integrate every team that's going to be affected by the project, you might never rack up these incremental wins to begin with because you didn't get enough stakeholders involved from day one. So if you are going to approach this from a larger project point of view that's going to affect an entire organization, you need to start planning on how to integrate every single person who's involved from day one and break down those silos. Otherwise, you might never even get to the deployment stage. And look, this is where the consulting departments for a lot of firms are very, very important. It's part of the digital transformation pathway.
Yeah.
But I agree with Lucas. You want to start small, get a project, learn from it, and then scale it out.
Yeah. So a comment on this one, what I have seen in the financial sector, talking to many of the big financial firms and the smaller ones, I think the issue really comes out that understanding AI models and providing the feasibility of using AI to get your solution is kind of like the first stage. And a lot of companies don't think about the main infrastructure and the architecture you need to scale these things out. And one of the biggest things I have seen talking to a lot of the financial firms is that, data. How do you handle data? You have to put the entire value chain of a production together before you can get to production. And I think in our sector, the understanding of what it takes to put the whole entire architecture together. For example, what is your data strategy? What is your data management going to look like? A lot of people don't think about that. They just think about, okay, what's my model? But the reality is, what's the pipeline? What's a pipeline of data, and what are the economics of data? And then what is your technology in dealing with data? That isn't there, and I think that's the main, in my opinion, what I have seen is the main barrier for getting to production. Now,
Yeah, that's a good point.
Yeah, go
How are
ahead.
we doing on time? I don't want to, 2 minutes, good. I don't want to stand
make it
between
2
you
minutes,
guys and
yes.
the food, so.
All right, so
like,
what
I
were
get
the
it.
nuclear physics questions again? I forgot those ones.
you don't want me to get started, but
Maybe over dinner.
yeah, maybe I
if
was
you can
going to
stop
talk
me.
about entanglement
That's an easy
theory.
one.
If that's
an easy one.
If you're interested,
I've
it's,
watched enough Star Trek to get that one right.
All right, rapid
So-
fire question here, and then we'll close.
Yeah, I think a rapid fire question is good because I have a couple of quick ones that I want to ask. So, cloud or on-prem, which one would you use when you, if you want to get started?
Easy. If your stuff is already in the cloud, go on the cloud. If you're all on-prem, do it on-prem. And use an
Okay.
API.
Okay,
Yeah, what he said.
what he said. Okay. Another one. In your opinion, most important benefit of using AI ML? A quick one.
That's not quick. That's a very tough question.
Pass.
What he said. No, I would say the immediate benefit is just you do have multiple methods to improve what you're doing today.
Okay,
And I just
I'll
say
go
keep
with
an
that.
open mind. Keep an open mind. There's always ways to improve what you're doing. If you're completely complacent, you're never going to get better.
Yeah. I'll
If you
go
can,
with
if
that.
you can upskill yourself,
Yeah,
like,
Yeah.
if you could, if the product that you received with the example that I gave actually gave you the leverage that I reported that it does, I would pay $40 to be that much more productive at work.
absolutely. Absolutely. Very good
I like
point.
that answer.
Very good, very good. All right. I had another question, but I think you've answered it. Generative AI possibilities, with video coming in. Now it's going to be multimodal, right? It's not just going to be text. So it gives you a lot more, right? So any thought on, what is generative AI possibilities? What do you think?
I think the trajectory is going to be what it always has been. It's going to be games and kind of entertainment things, and then we'll figure out what the actual use cases are of that. Like, I think to be super cliche, like as cliche as possible, I think that possibilities are kind of endless, but
Yeah.
I think they're going to suck for a while.
Yeah.
Yeah.
Okay.
I would think there's a lot of smart people out there, a lot of people smarter than me that have thought of things that I would never think of. And that's just, that's part of the amazing thing about the human creativity, the aspect of human creativity. Who knows what we're going to have? Most of what we even talked about here could be obsolete by the time we're out of this room.
Sure,
All right.
sure. Okay.
We're being kicked out.
I think we are getting kicked out, so I was going to ask one last question. Can I ask one last
Yes, go
question?
ahead.
Value of certifications. Are you guys in favor of getting a certificate or not?
Yes. I have a biology background. Everything I've done in finance, I'm self-taught, going through my CFA, FRM, FDP. I needed some of these certificates for credibility, absolutely. Look, I've had great teachers, great mentors along the way, but if it wasn't for these self-study programs and these certificates, this is what really just gave me a career in a company.
Very good.
If you need it, yes. If you get bored, this is a more productive use. of your time than probably video games. And then otherwise, if it's not going to be useful to you, no.
Got it. Well, thank you very much. Appreciate it.
Wonderful. Thank you so much. How about a round of applause for our presenters here today?
Thank you. Thank you.
Thank you. So those of you that are here in the room, we are having a reception, so we've got an open bar and some hors d'oeuvres. And a special thank you to everyone that joined us virtually. We really appreciated your engagement. And we will be sending out a copy of the recording, and we'll get you the slides and contact information. We saw lots of questions in the chat, so we'll answer all those for you in the next couple days. But that ends our time today, and I just can't thank you enough for being here.
Thank you. Thank you.